Assalamualaikum and salam sejahtera. Welcome to FAR110 lecture series number 11, and this video is to discuss on the financial adjustments, the post-trial accounting adjustment. First of all, we'll look into the adjustment on the non-current asset that is relating to the topic of depreciations. When we buy a non-current asset, the cost of non-current asset will include the purchase price of the product, the asset, and the transportation cost that it may incur to bring the non-current asset to the business premise, and any taxes or duty that imposed on the non-current asset that you need to pay them first before you actually receive the non-current asset. And also will include any installation cost or testing cost in order for the non-current asset is ready and function to be used by the business. So these are the costs that would be included in the non-current asset acquisitions. For example, on the 1st of February, business bought 55 ringgit by check, a lorry that inclusive 1,500 import duty, 250 road tax, and 1,650 ringgit the first party insurance, and 2,000 ringgit incurred for painting the business details on the lorry. And when you are required to the cost of purchasing the lorry, you must remember the non-current asset only include the cost that added value to the non-current asset. Those are, let's say, for recurring expenses. For example, the insurance and road tax. Those two are recurring expenses for the lorry, so it will not be included in the non-current asset, the actual cost of that particular asset. So your record would be, even though you pay 55,000, but you need to distinguish to separate the expenses. This is called the revenue expenditure, not capital expenditure, the road tax and also the insurance will be separated from the actual cost that we will record the vehicle, the lorry, in our account. So your vehicle only recorded 53,100. That is include the painting and the import duty, because the import duty is not the duty for the lorry is not recurring. And most of tangible assets are subject to depreciations. The value of the tangible non-current asset will have a less value or during the year onwards. So it's subject to depreciate in value. So the depreciations is defined as the gradual using up the non-current asset over the accounting period or accounting years that the non-current asset has been used. So the record would be debit depreciation account and credit the accumulated depreciation account. It will not affect the actual cost. You need to open up another set of accounts to show there is a possibility of reducing the cost, because this depreciation is an estimation, not the actual one. And the depreciations will be regarded as expenses, so that you need to record to show a display in the statement of profit or loss, and the accumulated depreciation will be shown in the statement of financial positions. But however, remember that we discussed on the format of statement of financial positions. The tangible asset has 3 columns, that is at cost, accumulated depreciations, and the carrying value, because the original cost will be deducted with the accumulated depreciations to arrive the carrying amount in value. And the cost of depreciations, why the non-current is depreciate. The first, the normal or the most common is because of the wear and tear. The physical up we use the non-current asset. For example, the car, we drive it to many miles and kilometers, so it will end up depreciating value because of the usage of that particular product. And the obsolescence means that the asset has been outdated. For some of our computers that you bought in more than 5 years, sometimes it's already obsolete. You cannot use it to update or use it to add up the application and so on. So once it's outdated, so it depreciates in value. And some of electronic products, the trend or the technology is fast moving, so sometimes within months the value of your electronic products dropped in value. A fraction of time means that it will less valuable when time passes, most probably because of the change in technology, or probably the change in trend, or the change in the economic value. So it's less valuable when the time passes. So when less valuable, so it's subject to depreciating value. Inadequacy or superfluity means that when the size of the firm changes, for example, the server that you bought for 5 people or 10 people in your company, it's sufficient in 2010, but now in 2020 you have more than 100 employees, so your server is no longer capable to cater the whole of your employees, so it becomes less valuable for your firm. Physical factors, for example, floods or tsunami or excess heat, it can factorize your asset to be less valuable. And fluctuation of price, this is where you bought the non-current asset on credit from overseas using foreign exchange currencies. So once you use foreign currencies, and when there is a fluctuations of prices in your currencies, so they could probably be subject to depreciating the value of your asset. There are two methods actually in calculating the depreciations of your tangible asset. The first method we call the straight line, or some of the books it says depreciate on cost. So these using this method, your depreciations is the same amount in every year. So you have equal portions to be charged in depreciation account. So your formula to calculate these depreciations, first you have the original cost, deduct with expected the salvage value, and divide with the expected economic life, or expected the useful life in years. For example, we have cost of the car is 55,000, and the useful life expected to be 10 years, and the scrap value, means the salvage value, is 5,000. So you will calculate depreciation value per annum can be calculated like this: 55,000 deduct with 5,000. 5,000 is the scrap value or the salvage value, and divide with the 10 years of expected economic life. So each year your depreciations will be charged as 5,000 ringgit. So year one, you will debit the depreciations, motor vehicle, MV is motor vehicle, 5,000 ringgit, and credit accumulated depreciation motor vehicles, 5,000 ringgit, and you need to differentiate among the non-current assets. So if you have let's say 6 tangible assets that subject to depreciating value, so you will have 6 depreciation accounts according to each of the tangible non-current asset. Okay, the year 2 debit depreciation motor vehicles, and it's the same. You credit the accumulated depreciation on motor vehicle. This is the first method. And another one, you can use the percentage that has been suggested as in Lembaga Hasil Dalam Negeri website, the rate of capital allowances. So you can use that, the percentage, as your depreciation rate. You can use that, or otherwise you can find some other calculate using the formula and so on to arrive to justify the percentage of depreciation value for your tangible non-current asset. And formula to calculate is simple: cost multiplied with depreciation rate. So using the previous example, the cost of the car is 55,000 and depreciated at 10% per annum, so your depreciation value will be 5,500 because you multiply with 10%. So year one, debit depreciation of motor vehicle 5,500, credit accumulated depreciations motor vehicle 5,500, and the year two again with the same amount. So in your statement of profit or loss for the year one, you will have in your statement of profit or loss, you have depreciations of motor vehicle 5,500 that you will be included in the other expenses part, and the in the statement of financial positions year 1, you will see that the non-current asset for tangible asset is motor vehicle. The cost is 55,000. The accumulated depreciation 5,500. The carrying amount would be 49,500. However, in year 2, you can see the statement of profit or loss again, depreciations of motor vehicle that you will be include in other expenses. The amount is the same, 5,500. However, you can see that in the statement of financial positions year 2, the accumulated depreciations has been accumulated, add up the last year depreciation amount and this year, the year 2 depreciation amount, 5,500 plus 5,500, it becomes 11,000, the accumulated depreciations. So your motor vehicle at cost means that when you buy that motor vehicle, the cost is 55,000, and you by year 2, 11,000 has been assumed depreciate in value. So your carrying amount or the estimated value currently in the year 2 is 44,000 for your motor vehicle. The second method is using reducing balance or sum of the book. You can see that on carrying amount, depreciation on carrying amount means that you need to find out what is the carrying value of that tangible non-current asset. Then you will multiply with the percentage rate of depreciating value. So percent charge as depreciations will be reduced in each year when it progresses. The formula to calculate is the cost deduct with accumulated depreciations means that you need to find out the carrying amount or the carrying value of that tangible non-current asset and then multiply with the rate of depreciations which are subject to this particular tangible non-current asset. Again, we use the same example. The cost of the car is 55,000 and depreciate 10% per annum, but use reducing balance method. So depreciations in year 1, since year 1 you have no prior depreciations, so you will deduct 0. So 55,000 multiplied with 10% is 5,500. So meaning that if you choose reducing balance or straight lines method, year 1, if you use the same rate, depreciation value is the same. However, for depreciations in year 2, since year 1 you have allowed the 5,500 for depreciations, you have provided that. So in year 2, you need to deduct the 5,500 from the 55,000, the cost of the car. Then you can multiply with the 10% the rate of depreciations, and the depreciations amount for year 2 become less. It becomes 4,950. It's not the same as the year 1. So the record for year 1, debit depreciations motor vehicle 5,500 and credit the accumulated depreciations 5,500. And year 2, the amount is different. Debit depreciation 4,950 and credit the accumulated depreciations motor vehicle 4,950. So in your statement of profit or loss for year 1, In the other expenses, depreciations of motor vehicle, again the same as the straight line method. The amount is the same, 5,500. And the statement of financial positions at year 1, again in the non-current asset part, you will have motor vehicle at cost 55,000, deduct the accumulated depreciation 5,500, and the carrying value would be 49,500. Is the same as if you use straight line method. However, the amount of accumulated depreciation will be different in year 2. Statement of profit or loss will be charged depreciation of motor vehicles. It's no longer 5,500, but it reduced in the amount of depreciations to 4,950. And also in your statement of financial positions at year 2, you can see that motor vehicle at cost 55,000, and the accumulated depreciation is become less than if you use straight line method. So the accumulated depreciations 10,450, and the carrying value would be more than if you use straight line method. Sometimes people ask which actually method to be used. In my opinion, if the depreciations is stable among the years, so you should use a straight line method. But if your depreciations is rapid, means that the first year or the second year you will have a lot of depreciating in value, especially electronic products that depends on the technology that advance moving forward. So the possible of depreciating value is very high in the first year and the second year, and become less the years later. So it's better for you to use reducing balance method rather than straight line method. Now moving on, for the second part of adjustment is accruals and prepayment. Accruals means that something that you have not received or not paid. Well, the keyword is there, not. But the prepayment is something that you already received or already paid. So you are prepaid the amount. So the accrual concept actually have an implications of prepaid expenses. So expenses has been paid in advance but should not appear in the current period. And you have implication of accrued expenses. Expenses not being paid but should appear in the current period accounts. And prepaid revenues, where revenues paid in advance, then should not appear in the current period. And accrued revenues not being paid, I mean the revenues, the cash money has not been received but should have appeared in the current period of accounts. So these implications arise if you know when we are using the accrual concepts. So the treatment is a statement of financial positions. So any accruals, expenses, and revenue would be treated as whether it's a current asset or current liability. So accruals and of revenues means that the revenue should have received the cash money but not yet received. So the statement, the treatment in the statement of financial position should be recorded in the current asset. And the accruals of expenses means you have not paid the expenses, so the treatment will be current liability because you actually owe the third party or somebody else. And the prepayments of revenues will be considered as current liability because that is not your money. yet, and the prepayment or expenses will be recorded as current asset in the statement of financial positions. Let's have a look example for prepaid expenses. Let's say you renewed your van 12-month insurance in 1st of April. So, so the insurance is covered from 1st of April 2019 until 31st March 2020. So if your business year ended at 31st December 2019, so you will have an extra payment that should not be recorded in this year, but for next year, for 2020. So you can see that the insurance only for 9 months for 2019 and another 3 months for the next year. So you will have these implications of prepaid expenses. When you say that you pay 2,400 paid by cash, so you must divide with 12 months. So 9 months will be recorded for 2019, and in another 3 months will be recorded in 2020. So your insurance account ledger, you can see that the 1st of April you already paid 2,400 ringgit, but you need to adjust showing that there is a prepaid insurance of 600 3 months payment advance for the next year, for 2020. So your balances at the 31st December 2019, only 1,800 should be charged in your statement of profit or loss. And the prepaid insurance becomes a current asset, and you will show in the statement of financial positions that is 600 prepaid insurance. And of course the cash, you should show that there is a credit amount you already paid 2,400 ringgit. Okay, then let's have a look on the accrued expenses example. On 30th December 2019, salary has been paid. You already paid your employee 40,000 ringgit. However, there is a bonuses for 2019 amounted to 2,400 ringgit will be paid next year. So when you have a business year end, the accounting year end at 31st December 2019, you have 2,400 ringgit that still has not been paid for salary, because bonuses is part of the salary. So your salary account, you will show that you already paid 40,000, mean debit account salary 40,000, and that on 31st December you need to acknowledge or to show that there is accrued salary of 2,400. That is the bonuses that you promised to pay to your employees but will be paid in next year. So your balances for salary should be 42,400 ringgit. That is the amount should be appear in your statement of profit or loss. So your accrued salary becomes your current liability that will be shown in statement of financial positions, accrued salary 2,400 ringgit. And of course, the bank account has been less 40,000 because you paid the salary. Now look example on the prepaid revenues. Means that you already paid, the revenues are already been paid by the third party, so you have an extra money, but it's not for this period. For example, on the 1st December 2019, business received 2 months rental, 2,000 ringgit paid by cash from tenant, and the business year ended 31st December 2019. So you actually only 1 month. For December is 1,000, and for January 2020 will be another 1,000. So the 1,000 is actually extra money you receive, but is for next year. So the rental received account, you already received the money, 2,000 ringgit. So you credit the rental receipt account 2,000 ringgit, but you need to recognize that that is a prepaid rental receipts, 1,000 ringgit for next year. So your prepaid rental receipt becomes your current liability because that 1,000 ringgit is still yet not your money, it's somebody else's money. But we will adjust the prepaid rental accounts, prepaid rental receipt account next year to accommodate that 1,000 for January 2020. And of course, the cash accounts, you receive 2,000 ringgit extra money of 1,000 of the rental received. Okay, last example on the accrued revenues. Let's say on the 2nd January 2019, business deposited 50,000 ringgit in 5%. 15-month deposit means that the 5% is the dividend for, per year, per annum dividend that should be paid each year. However, dividend of the fixed deposit will be paid once you redeem that fixed deposits at the end of 15 months, that the maturity date. So, but you need to recognize you actually should have a dividend 5% for 2019 because your business year ended at 2019, 31st December 2019, but the cash money only will be received next year. So you need to recognize it, a dividend that you should receive for this 2019. Okay. The ledger that you will record, okay, you have credited the bank account to buy the fixed deposit. So you have fixed deposit 50,000 in your ledger records. However, you need to recognize that it should be a dividend received at 31st December 2019. So you will credit dividend received with the particular of accrued dividend received. So your dividend receipts must be appear in your statement of profit or loss and other income. There is a dividend received of 2,500 ringgit, and your accrued dividend received will be appeared in your statement of financial positions as the current asset because you will be debited the accrued dividend received 2,500 ringgit. So your adjustment in the financial statement using the 4 examples that I described previously. So you have a rental, other revenues, the rental 2,000 ringgit, and you must deduct with 1,000 ringgit because you have an advance payment of the rental for January 2020. So your in statement of profit or loss, you only record 1,000 ringgit for the revenues of rental received. And accrued dividend, the dividend, you can just put dividend 2,500 ringgit in for the name of in the statement of profit or loss because the 2,500 ringgit actually has not been paid yet by the bank. And in the other expenses where you have insurance, you actually already paid 2,400 ringgit, but the 600 is actually for the 3 months in 2020 for January, February, and March 2020, the insurance. So your statement of profit or loss only record the amount of 1,800 ringgit for the insurance. So, and the statement of profit or loss ended 31st December 2019, you must include the bonuses for salary that has not been paid, but you must record or recognize as expenses. Then you should show in the statement of profit or loss 31st December 2019 there is a 42,400 ringgit is actually a actual amount of salary for the year. And the statement of financial positions is at 31st December 2019. You will have in your current asset accrued dividend received 2,500 ringgit because we recognize it is our money, but the cash is not received yet. And prepaid insurance 600 ringgit. And current liability, you have accrued salary 2,400 ringgit. You not yet paid to your employees, and prepaid rental received the 1,000 actually it's not your money now for period 2019 is for 2020. So tips to memorize. Sometimes it's very difficult to recognize which one is current asset, which one is current liability, what to add, what to deduct. So tips to memorize. Any accruals means that something that has not received the cash money or not being paid yet, something that not. Sometimes people can, the books can, or the exam questions will be used the word as outstanding, means have not been paid yet. Or you will say that has not been paid or has not been received. So something not. So whenever you say is an accrual, something that has not been paid or not been received, so the cash money is not being received or the cash money has not been paid. So you need to add in this statement of profit or loss. So something not, you add. And prepayments, something that already paid of money, so you must deduct because that is not for this year, it's for next year. So the accruals expenses, accrued expenses must be recognized as current liability. It's logic. You have not paid your electricity or you have not paid your internet bills, so you owe somebody else. When you owe somebody else, it becomes current liability. It's very simple, it's very easy to memorize that. So accrued expenses must be recorded as a current liability in your statement of financial positions. However, for prepayments expenses, it's vice versa. It's recorded in current asset. So accruals in revenue, something that you have not received yet. So something is not received that you will recognize that is our money, but we haven't received it yet. So it's our money, it must be recorded as current asset. However, for prepayments, something that you already received but not yours for this year, so you will record as current liability. So you can use this table. Tips to memorize. Accrued expenses, current liability. Accrued revenue, current asset. Prepaid expenses becomes current asset, and prepaid revenues becomes the current liability. So if you use this table, memorize this table, you will not have an error in making the adjustment of accruals and prepayment. That's all for now for this video. Thank you for watching. Watch out for the next video for the next topic. Bye bye.